It's the first recording for 2023, and we're looking at positioning the portfolio into February and March of this year. We're also looking at the trading shares to cover this week, and the man guiding us through is Gary Glover from Novus Capital. Good morning, Gary. How are you?
I'm good, Chris.
Good to be back and
refreshed.
Refreshed indeed.
Yeah.
Nice summer break. And probably to kick the year off, we should actually say thank you to the support we had last year for all the listeners, helping the channel grow. And they've asked how they can help. So if they want, they can like the video and share it in the comments below. So that's answering that quick one out the blocks. But if we're looking at the year ahead, we've come into this year out of a stellar year that you had for 2022. A quick recap says the major October lows that you highlighted well out. We hit those. Then we looked for history. You showed us that out of those lows, the Dow often runs strong for a 12 to 14 month cycle. We've had a bit of that rally where you're looking to sell into that mid-December area. I guess the question now becomes, what's the focus from here, Gary?
Yeah, no, you're right. So the average rally out of a midterm year for the Dow was around 21%, which we pretty much nailed. And that's for the last 2 months of the year, which we got from our October into December. And then the average rally from that October low into the following year, so obviously into the end of 2023, is 49. I think it's 49% for the Dow Jones. So that's an additional 28% higher here after that peak. So it's a fairly decent move here. So it doesn't feel like we'll get that. Everyone's pretty bearish out there. But I'm still sort of somewhat optimistic that we'll get a bit of a move here. And most people didn't see the 21% coming. So I dare say that no one's going to see the extra 28% coming if it does come as well. But the thing that I could put in context is that I know everyone's pretty bearish, pretty negative there, but everyone was pretty negative at the October low as well. And even though we've had a bit of a bounce and then we've retreated again, everyone's still pretty bearish here again. We've seen all the Wall Street predictions. I think 4,500 on the S&P, which is about a 15% gain from the current lows here, is one of the most bullish there forecasts. I think that might be Deutsche Bank there, whereas most of them are sort of sitting only around a couple percent higher here, around sort of 4,000 for the S&P. So no one's expecting any gains here. Everyone's expecting a recession, but if we go back and look at those 40s and 70s sort of style charts there, which is those high inflationary periods of the past, we could see there in those periods there, as much as the market might sit still for a long period of time, the swings, the volatility in those periods is nothing short of phenomenal. So some really, really big rallies in there, and all it takes is, as we mentioned in the past, is to see some easing in that inflation, and the markets can rip. And then when it flares back up again, they'll come back down again, and then it'll ease off and they rip again. So those ranges for those markets of 40s and 70s, just go back and we've covered them previous charts.
We'll put a link on screen, I think.
You can go back and look at those. I mean, you just see the sort of moves that you saw in those periods there. I think we covered it. I covered it in detail there one of those weeks there. So it's worth basically printing that one off and just keeping it on your trading desk, because that to me, that's the worst case scenario, Chris, is that type of market where you're up and down, but the big moves. So people are out there. They're getting caught up in the feeling of the market and saying rates getting squeezed higher. Obviously, still inflation, sort of, everyone's pricing in a recession. So they're all sort of getting caught up into, these are all fundamentals here, but the market looks ahead, always looked ahead. So got to look at how markets behaved in the past in those similar circumstances, and people forget to do that. They trade how they feel. They don't basically go out and investigate what markets sort of do. And so I'll just explore everyone just to go back and recap, go and look at those 40s and 70s old charts, because that's the worst case scenario. And even that's got some really good opportunities here. And you're seeing it across the market already, Chris, with just look across the big caps here, where we're up and down, up and down, up and down. There's some, just look at Combank, look at the chart. That thing is, we're up to 108 and back down to the low 90s, and we're back to 106 and then back to the high 90s. It's, really, even the strongest stocks are sort of swinging around quite substantially here. But just looking at that index there, I think that this NASDAQ here actually has been interesting, Chris, because the last 2 days, the NASDAQ has actually outperformed the Dow. So the Dow was off this morning, so was the S&P, yet the NASDAQ was up. The other day when the market was up big, the NASDAQ was up stronger as well. So I was like, okay, I can't remember in the last year where the NASDAQ has outperformed the other indices 2 days in a row. I honestly can't. I don't think that's happened. I mean, maybe it has. So someone can prove me wrong, but that's the first time I've seen that. So it's like there's maybe a slight change of character in there. But yeah. But I think we sort of spoke about this NASDAQ maybe replicating that 2002, 2003 period, and that sort of, was a slow climb too. So we saw a bit of a dull bounce like we've got here, but then we just sort of lulled out. We started to build a base here. So I'm a bit sort of neutral to sort of slightly positive here, but I think this NASDAQ might take a time to build. Definitely seeing some of the lower volumes on, that sort of, the NASDAQ sort of sold off for a few weeks, and particularly the last couple of weeks of that low there, the volume had dried up. And we've seen some of the indicators actually show some bullish divergence in there as well. So, but yeah, so there's actually some reasonable signs here starting to sort of show here, but I think it's going to take a little while to build here. And I still think that 2002, 2003, that 20-year cycle is a good roadmap. That's been a good roadmap all along here. It's very similar, apart from the inflation component. It's quite a similar type of market there. So I'm optimistic here, but I think this will take a little while to get going here.
Well, that's the NASDAQ, and as you've noted out, it's been a massive underperformer throughout the last year or so. We can see on the charts it's almost back to its lows, but as you noted, it has outperformed just recently. For the S&P, you were saying in your report this week that it didn't come back as much as you like. Is there more that you're selling? It's more towards a sideways churn for us coming into February, March, or are you seeing something else?
Yeah, look, it's come back my minimum amount, just not my preferred sort of maximum amount. I would like to sort of come down and square that left shoulder there. Would have been sort of probably a better. So still might sort of meander down there into February, March there. Might do sort of something like, again, that sort of 2002, 2003 low there, where it really sort of messed around, sort of congestion for a bit. But the interesting thing is all our cycles there, I think bar the 20-year cycle, every other cycle is actually quite positive here for the market there. So I know the fundamentals look a little weak here. Everyone's talking recession and rates are going to push higher, so it's definitely going to sort of squeeze a little bit there. So definitely some negative pressures around here, but the question is, are they priced in? I think some of those are priced in there. We might be a little optimistic about the Fed sort of not maybe easing early here. I think Powell's made that clear he's not going to. I think he realizes the seriousness of inflation. That's hopefully they won't make the same mistakes they made in the sort of 70s and move too early and then for it to come back again. So I think I'll keep rates sort of there and want to see inflation really sort of cool off here and then sort of continue to stay away, and then that'll be good. So that's why I think it'll be messy here. I just think it aligns more that will be just sort of might do a bit of work here. You might get slight softness there, but yeah, I'm still sort of optimistic. I'm just not sure. The next couple of months I think might be messy here. So I think I'm more sort of bullish sort of February, March after that period. I just think it takes a little bit of time to play out here. January the 12th actually is, funny enough, sort of market has a habit of running into that date there. One of our viewers actually two of our viewers actually reached out to me and said that's the CPI date. So that makes sense. So be interesting to sort of see how we trade into that date, where the market runs up into that date. Because I think everyone is positioned for a lower CPI. But yeah, no, we'll see how it travels there. But yeah, I just think it's going to be messy here. I think there's opportunities there. I'm just being a little bit, I'm still trading here. I'm probably keeping myself under that 50% weighting. So I'm still thinking it's a bit of a choppy market. So I don't think it's time to be fully invested, but I think there's opportunities there. I think just got to be careful not to be too negative there. So I think it could be, I think there's still opportunities there. So, but yeah, just go easy here. Probably just, take sort of smalling instead of holding out for, 20-30% gains there, probably just be a bit more modest, maybe something like 4 to 5% risk for a 15-18% return. Something like that's probably where I'd be looking at something like that. Just have your risk reward a little bit narrower, just because it's still a bit choppy here.
That's good insight when the market's not giving clear indications. If we take your analysis, put that over to the Aussie markets, the ASX, it's been a little bit difficult to gauge, as it normally is this time of year. On holidays, there's lower volumes coming through. Is that hindering your ability to gauge, or are you still getting good signals?
Yeah, I think there's just a bit of a mixed bag here. Just sort of definitely saying sectors, kind of roll here. So roll on and then roll off. So obviously we're seeing gold have a bit of a tear at the moment, which is pretty cool. Been sort of watching that sector for a while. I think it sort of came up. That sector came off and gave us a bit of a universal sort of long signal there, probably 6 to 8 weeks ago on the 30/30 report there. When we had like 6 or 8 stocks in there that 1 week, and then they were leading the next, within a few weeks. So so seeing things like that. But you've seen all stocks cool off here, which is obviously one of the inflationary pressures. This is quite good. Seen lithium roll off here recently. Just seeing a bit of a mixed bag here with sort of things up and down here. But just notice we've had a bit of a pullback on the Aussie market there. Had a nice reversal there last week, which looks kind of positive, but the volume was very light there. I know it's sort of holiday season there. Volumes are lighter there, but
even so, that was still pretty light, wasn't it?
Yeah, very light, and a wide range week as well. So when you sort of have a small range week, you can have a light volume, but when you sort of have a wide range week like that and on those sort of volumes there, that's usually a bit odd as well. So it's not showing too much strength there. So I'm still a little bit cagey. I'm just really finding I think it's just really interesting, the sort of commodities, because as a highlight in this in the newsletter here, the commodities index is actually is making a series of lower highs, actually breaking down. So you've seen the oil price and even some of the coal price, and so some of the lithium oil stocks. So some of those resource prices, actually commodity prices, are actually starting to weaken off here. Yet BHP, Rio, Fortescue, they're all at new highs, and the FTSE, which is another basically sort of resource, it's basically got a lot of energy stocks, resource stocks in, similar to Australia, got heavily weighting on those sort of stocks. So it's basically gone to a new high there last week. So just quite amazing there. So just interesting here that the commodities are sort of leading while the commodity index is sort of going down, and normally the stocks lead the commodities. So it's So I just I'm finding that a little bit, that's pretty, I'm finding that sort of interesting, but also there's they're not in alignment as well. So and I'm just a little worried about resources there. If that NASDAQ, if inflation does cool right off here, if the Fed can get inflation under control, then you should see a weakness in some of those commodity prices, and that'll bring that also will dampen some of the inflationary pressures, and then those commodities should come back. I mean, commodity prices will come off, as we're starting to see, but the resource stocks should cool off as well. So far we haven't seen that. So far we're seeing those resource stocks trade pretty well up and down. So that's the one thing that's the thing I'm finding most interesting here, sort of maybe at odds with the market. But I do know that it really does, historically, they're sort of, if inflation stays high, then commodity prices remain high. If inflation does cool off, then you'll see the commodity prices cool off here. So, yeah. So I think we'll be interesting to see what happens here on the 12th of January in terms of sort of how much that CPI number sort of, cools off. I think everyone's expecting a lower number, but we're just curious to sort of see how low that does come off, if it does come off enough there to get people excited about inflationary pressures sort of easing. So, but yeah, you just got a few divergences in the market there at the moment. So, to me, when I see people ask me about BHP and Rio and Forestry, to me they're too hard to me. I can see, there's a massive head and shoulders on the XMJ, which is the materials index. So that, there's a topping pattern for a lot of those big resource stocks as well. So that can be quite dangerous here as well. So, I just don't trust those. I think,
At least you're mentioning anomalies with the CRB, the FTSE versus the commodity prices in Rio and BHP. That sort of reminds me throughout last year and the year before, where you're noticing anomalies like this and patterns that normally transpire but not quite flowing out. A bit like gold, where you said, look, I'm expecting it to run.
Yeah.
The market's not showing it yet. Is that kind of where you can find some good opportunities?
Yeah, because I think the commodities could actually have a fairly large decline here. So I think there's potentially a good short-term, like there's a short trade in there, but they so far haven't shown weakness. They're actually showing strength. So to sort of stand in front of that in a high inflationary environment would be committing, trading suicide. So I'm not keen on that. But
collecting pennies on train tracks kind of thing.
But I do think that's got the potential, like gold's got the potential to have a big move, which never sort of came, but then now it's starting to come. It's come very late here. The commodity stocks are like the BHPs and Rios Fortescues. They have the potential to have a big move on the downside here once this cycle ends. But again, that we haven't seen that yet. So I'm watching for that, but I definitely would not be at this stage. They're showing strength. So even though the commodities are starting to cool off and inflationary pressures are starting to ease off here, the stocks are actually showing strength. So, so we don't fight the tape, as they say. So I'll be watching those sort of stocks. Obviously, if I saw any, that FTSE as well going to a new high, just got to be careful to sort of, when you're seeing markets go to new highs up there, make sure they don't go to a new high and fail, like a big fifth wave, and then come flash away back. But yeah, if that breaks here cleanly, there's Davis would be buying a breakout going to a new high. So even though it's a choppy market here, that's at this stage it's still fairly positive.
Well, before we move to the trading shares and the opportunities in them, the last one's the Dow, which throughout this recovery cycle since the low has been sort of the lead out, the standout market and indice. What are you seeing, how that's moving now? Is there anything special coming out of the Dow?
Yeah, we had the average move, Chris. That's had the average, that's an average rally off the midterm year. So right on the dot. So and then it's pulled back here, which is great. I was looking for a bit of a shallow pullback. So again, I don't know, is this too small here? I think it needs to use up a bit more time here. So I still prefer to sort of see it come back a bit further, but it is showing relative strength, and maybe we'll only sort of see a shallow sort of move here. But I still prefer to sort of see a Feb low. But most of the cycles are actually positive right now, Chris, not negative. Only one of the cycles is negative, whereas probably 3 or 4 of the cycles are all quite positive here. So even though the noise is negative. So so that's why I was sort of saying I'm not in cash here. I'm actually probably half invested because I still think there's opportunities there. But I can't put the foot on the gas here because I think I still prefer a move to come back into Feb. But if I see sort of a shallow retracement back into Feb there, then I'll probably get a bit more excited and start to get heavily invested. But yeah, so you just got to trade the odds here at this stage. It's still a bit tricky. So, but a lot of the cycles are still quite positive here. So that's why it can't be not invested for me personally, because if the market better keep rallying here, and I'm totally not in the market there, then I'm going to totally underperform here, which I think is a great risk as well. And I think any pullback here will be probably more of a consolidation. It won't be deep. So if I am a little bit invested and it does edge back, I don't think it's going to hurt me too much.
Yeah, that's a good insight to see. So any pullback will probably be just consolidation.
Yeah, I don't think it's going to be too heavy. So if I'm in the right stocks, I can probably, if it's, some stocks can still go up here if it's just a bit of a consolidation there. It's like, well, some sectors might cool right off here. So
one of the stocks in your report you've picked up as corporate travel, and you've noted that it's a bit of a rare standout at the moment, because in the travel sector, a lot of them raised equity, and you've covered that many times. It's Flight Centre and Webjet. It's how that changed the market cap. But they're still heading down, corporate travel. So what are you looking at on the chart here for opportunity to see?
Yeah, so I noticed these sort of descending wedges, and even sometimes these descending channels there. If they've got plenty of touches there, they've got quite a bit of validity to them, which this one has got 3 touches along the top side there, and I think we've got probably at least 4 touches along the bottom side there. So those sort of patterns there, the good ones will basically sort of stay within the pattern and then break out, and then maybe come back and kiss the range and then go. But oftentimes you see them actually overshoot to the downside. So basically have that exhaustion where they actually break down the range. So it's almost like a false break, you almost sort of say, of the range, and that can be exhaustive for the stock here. And you've seen there the volume. There was a volume spike at the last the 2 weeks on the low there. And now we've started to rally here. So this is pretty interesting to me, because that's sort of exhaustive in nature. It's broken that range there, quite a lot of visibility, that pattern there. Quite interesting that travel sector has really turned around quite strongly here. Some of those travel stocks are doing quite well, probably Flight Centre and maybe corporate travel, probably 2 of them that aren't, but most of the others are doing very well. And Qantas, Webjet, even Air New Zealand's done have recovered quite nicely. So it's been quite a lot of recovery there. But this one has been. Corporate travel's the only one who didn't raise equity too. So whereas a lot of those other shares will never go back to the same highs, because there's twice as many shares on each sheet now. Corporate travel haven't done that. So being able to navigate through that period is pretty positive for them. So I think this one's interesting here, just because I think this one is once it recovers there, can move there. Everyone's probably still a bit worried about corporate travel, obviously, whether corporations will travel as much, but I think initially people will travel more domestically. I mean, firms that the thing about companies that are national, haven't seen their staff around around the states there, so like management will be getting out, seeing all their different state-based groups and getting out there, having a presence there. So international might be a little slow there. Obviously, the cost of international is a bit more, but I think you'll see plenty of domestic travel here. Just where you start to see international start to pick up there on the business side there. I think people are going to go crazy on the personal side there, as we're already sort of seeing some pretty good numbers there on travel. But I just think this is a pretty interesting one here. I think it's definitely want to keep an eye. I think if it breaks out the other side there, comes back and rests on that channel, I think that'll look fantastic.
Well, another one in sort of that recovery space is when we saw inflation take off, recession discussion kicked in, investors flocked to those defensive shares. And as you pointed out and we discussed, Australia is known to keep drinking during a recession. So Endeavour was running against the wind and climbed with all those inflation news. But now it's coming back. So what's catching your eye on this retracement here?
Yeah, look, I'm surprised it's actually come back this far, Chris. But the one thing was sort of with new stocks on the board there, if you go back and look at new IPOs and stuff, they're new companies there, they do have sometimes they can get a little hot and then they run pretty hard, and then they'll often come back and retest the lows, or go back and retest sort of, or go back and retest the all-time low, or go and retest the last low here. So Just notice there's a little bit of key support around that 610, 620 there, like a little bit of a, what you might call a little shelf. But yeah, I think that's a bit of a support zone there. And you can see the last 2 weeks, as much as we're down there, there's no volume down those. We saw that exhaustive into the big volume down week into the low there. But yeah, the volume has sort of dried up the last couple of weeks as well. So not showing up too much there. But I think, yeah, this one down around that sort of 610, 620 there, I think would be a pretty good entry there. So yeah, I do like this. Yeah, I think it's pretty solid group here. Reported pretty strongly so far. Probably why it's came out of the box pretty hard. But yeah, I still think this business can continue to grow here, and yeah, it's good segment as well.
Right. Well, we used to think of Wesfarmers in a similar space. They're a slightly different beast now, but they're showing higher lows, sitting near previous resistance. Could this even be coming towards one of your favourite setups?
Yeah, I was just sort of I just sort of highlight this because that oftentimes, basically markets can sit on top of each other, and like you break a range and then you sort of, then you run by that range as well. But oftentimes the size of that channel that you've been in there, when it does break down, it usually will, break around the same mark. So it gives you a bit of a target range there. But it's just interesting that range there has been, so far we've had a couple of touches off that sort of off that channel there, off the channel line, and that's exactly the sort of the channel there. So that's sort of something that I've noticed historically that just does happen this way. So whether it happens sort of more at horizontal channels, but also as well as these upward sloping channels as well, they can move by the same amount there. So yeah, just interesting. We got support at that last low with east back here. Volume's been pretty light last couple of weeks, and we bounced off this channel again there. So yeah, I do think this is probably a safe segment to be in. We sort of noticed that consumer staples do pretty well in tougher markets. Yes, I think this looks quite good here. So some early signs there of strength there, and I think I think this looks pretty positive there.
Nice. Well, that's a good analysis of that channel there with those parallel green lines and talking about the distance between them now becoming support along there. The final one, again in that similar space, Woolworths, that inflation roller coaster. This has been really volatile for a blue chip. Did you note Commonwealth Bank had been in a similar boat too?
Yeah.
But these are large and fast swings, Gary. What do you make of this rapid movement in Woolies?
Yeah, I just think, again, it's sort of a look. I know it's a sort of safe stock here, but I think these, historically, if you're in high inflationary periods here, the value stocks are the place to be. And we talk about this sort of 40-70 style moves there, where you're getting big moves, but you might be sort of standing still over the longer term, but the shorter term you're seeing big moves there. So still think these are the the right areas to be trading in there. We've seen things like Ramsay Healthcare had a really nice move, and Computer Share had that sort of reasonable pop there. So you're still getting pretty decent movements within these sort of bigger caps. So thing like Woolies here, we set a nice bounce off that sort of that three thrust sort of low there, so went to a sort of marginal new low, and we saw some good volume the 3 weeks up. Now we've come back 6 weeks, so twice as much time on the downside, and we haven't come back as deep there. I mean, kind of come back to an old sort of support zone there, and the volume's been pretty. The last 3 weeks been no volume on the downside at all as well, so not too much sort of selling going on there. So yeah, just think in lines of sort of how this market has sort of been trading behaviour for the last sort of 12 months. Yeah, I think that's likely to continue a bit longer here. So yeah, so looking at some of those value sort of stocks and moving high there. So I think that looks quite good as well. The only other sort of standout in the market to me is actually looking at some of those biotechs which we talk about. I think we mentioned in the 30/30 report, Chris, is look at stocks like Pro Medicus, PME, look at Polynovo, CUV, Clinovel, all those stocks are showing real strength here. So that biotech sort of healthcare sector is definitely one of the strongest sectors there. That led the rally. It's been pretty strong here. That's a sector there I think we're sort of going to keep a close eye on there momentum wise. I think anytime those sectors have a bit of a breather, have a consolidation there, that's definitely a sector which is showing some relative strength here, since October and continues to at the moment. So that's one of the few sectors I think looks really robust. Healthcare is the other one that I think has got some legs here, but it's a bit of a mixed bag there at the moment, but I think there's some opportunities there as well.
Well, they're the great insights to kick us off into 2023. So thank you very much for the analysis on the charts, the indices, and then the breakdown as to which charts you're looking at for this week. So thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
If you'd like to see the reports that Gary is talking about, which is the 30/30 report, there's a click on the right-hand side. There's a whole playlist there. And Gary's also mentioned earlier in the video some of the analysis that he's covered in earlier videos and also breakdowns, things about the 40s and the 70s, what inflation markets look like, leading themes and thematics. There's that whole playlist on the right-hand side as well, which are those little snippets and gems that Gary shared in previous episodes. Thank you very much, and we'll come back again later in the week.